In today's video, we're talking about how to invest in 2026, and I'm doing it in a way that actually answers the questions I keep seeing in the comments. Will the stock market keep climbing in 2026? Are gold and silver already too expensive? Did we miss the opportunity? Or is the real move still ahead? So today, I want to walk you through how I'm thinking about investing in 2026, and more importantly, why I'm thinking this way. Here's the simple reality most people overlook. When the Federal Reserve makes money cheaper, asset prices tend to go higher. That applies to stocks, ETFs, real assets, gold, silver, and anything the market treats like a store of value. That's not a hot take. That's how the system is designed to function. Before we go deeper, we have to talk about one word that explains almost everything in investing: liquidity. Let me break it down in plain English. Liquidity is how much money is available in the system and how easy it is to access. When liquidity is tight, borrowing gets expensive, lending slows down, and asset prices struggle. But when liquidity is plentiful, borrowing is cheaper, money moves freely, and asset prices tend to rise. Think of liquidity like water in a swimming pool. When the water level rises, everything floats higher. When the water drains out, everything sinks. And right now, the water level is rising again. This is where a lot of people get confused. They look around and say, prices feel too high, people are stressed, the economy doesn't feel strong. And they're not wrong about how it feels. But that's not how financial markets work. Markets don't just respond to vibes or headlines. Markets respond to access to money. When liquidity increases, money doesn't sit still. It moves. It hunts for returns. It flows into stocks, index funds, ETFs, precious metals, and anything perceived as protection against currency weakness. That's why markets can rise even when the economy feels mediocre, because money is being pushed into assets. Now let's connect this to the next piece: interest rates. The Federal Reserve controls short-term rates. When they raise rates, borrowing becomes more expensive. When they cut rates, borrowing becomes cheaper. And cheaper money changes behavior across the entire economy. Companies refinance debt. Investors take on more risk, cash yields less, so people look elsewhere for returns. And valuations rise because future earnings get discounted at lower rates. That's why rate cut cycles matter so much. And here's the key point for 2026. We're no longer in a tightening mindset. We're moving into an easing environment, and easing cycles historically support higher asset prices. Now we have to talk about the part people love to debate: money printing. When central banks expand their balance sheet, they'll give it a softer name: reserve management, liquidity operations, technical adjustments. But what matters isn't what they call it. What matters is what it does. It injects money into the financial system. And when you inject money into the system, you increase liquidity. When liquidity increases, asset prices tend to rise. That chain is simple, and it's consistent. Also, this kind of liquidity support rarely ends as quickly as people think, because here's the problem with the "they'll stop soon" argument. The system now depends on liquidity. The government runs large deficits. Banks need reserves. Markets depend on stable funding conditions. So once that liquidity spigot opens, shutting it too fast risks breaking something else. That's why liquidity cycles usually come in phases, not quick little bursts. Now let's talk about the US dollar, because this is the part that quietly drives a lot of what you're seeing. When interest rates fall and money supply expands, the dollar often weakens. Why? If rates fall, you get paid less to hold dollars. And if more dollars are created, each dollar's purchasing power is diluted. A weaker dollar tends to push up US stocks, gold, silver, and commodities. For example, if gold is priced in dollars and the dollar weakens, it takes more dollars to buy the same ounce of gold. And I want to make this crystal clear. When the price of gold rises, it's not always gold getting stronger. A lot of the time, it's the dollar getting weaker. If you own 1 ounce, you still own 1 ounce. What changed is the measuring stick, the currency. That's one reason gold and silver often perform well in easing cycles. This isn't ideology, it's arithmetic. And yes, this is widely understood. Policymakers rarely want an aggressively strong dollar for long periods. A super strong dollar can hurt exports, tighten global conditions, stress debt markets, and slow growth. But a moderately weaker dollar can support growth and make large debt loads easier to manage. So dollar weakness isn't always an accident. Sometimes it's the pressure release valve. Now I want to talk about something every investor needs to understand. What happens if the stock market falls sharply? If markets break hard, history suggests the Federal Reserve responds. We've seen it in 2008, we saw it in 2020, and we've seen it during multiple banking stress episodes. People call this the Fed put. That doesn't mean markets can't fall. They absolutely can. It means major declines tend to be met with policy support rate cuts, liquidity injections, emergency programs, and balance sheet expansion. Why does that happen? Because a crash doesn't stay in the stock market. It spreads into credit markets, employment, housing, consumer confidence, and even government finances. At that point, the cost of doing nothing becomes higher than the cost of stepping in, and this leads to a bigger question. Why does the Fed end up trapped into supporting the system? Because the system today is more sensitive to liquidity than ever. Debt levels are massive. Markets are highly interconnected. Stress spreads faster than before. So policy responses usually have to be faster and bigger. Now, looking ahead, there's another factor most people aren't paying attention to: leadership risk and leadership change. In 2026, the market will be watching the Fed's direction closely because shifts in leadership and tone can change priorities. And historically, when pressure builds, the bias tends to move toward easier policy, not tighter policy. Whether the messaging is support growth, stabilize markets, or protect employment, the practical impact is often the same: more accommodation when stress rises. So let's connect the dots. If rates are trending lower, liquidity is expanding, the dollar is softer, and the Fed remains willing to intervene when stress spikes, then asset prices have structural tailwinds. That doesn't mean markets go straight up. You will still see pullbacks, you will still see volatility, but in liquidity-rich environments, dips tend to get bought. So here's my high-level plan for 2026. I'm staying invested. I'm not sitting in cash hoping for the perfect crash while inflation quietly eats purchasing power. Not in this setup, not in this kind of environment. And if we get dips, I'm treating them like opportunities, because in a system where liquidity is expanding, corrections are often temporary interruptions, not permanent endings. Now I understand the fear, because the fear is real. People worry about buying the top, whether it's stocks, ETFs, gold, or silver. And a fair question is, how much higher can markets realistically go? My answer is this: as long as liquidity keeps expanding, and as long as the system keeps leaning on easier conditions, assets can stay elevated longer than most people think, because the bigger question isn't, did we miss it? The bigger question is, are the incentives changing, or are they staying the same? And if the incentives stay the same, money keeps flowing. Now, if you want to follow my investing journey and see what I'm investing in, plus get extra investing content, join my Patreon. Subscribe for more. Thanks for the support, and I hope you have a great day.